Markets are trading higher this morning, coming off the first down week in 3 weeks. All three major market gauges finishing down during the week on concerns over the Delta variant and the Federal Reserve's announcement that tapering could begin as early as this year. I would also point out, of course, there's the debacle, the Biden-led debacle in Afghanistan. What does that mean for the safety of this country and our relationship with allies for years to come? We're waiting for the Federal Reserve's Jackson Hole meeting coming up later this week. Joining me now, Lane Generational founder and managing partner, former Raymond James Vice Chairman Fred Lane. Also joining the conversation all morning long, Republican strategist, lead partner at the Madison firm, Jonathan Madison, and Lafler Tengler Investments Chief Investment Officer, Nancy Tengler. Good to see all of you this morning. Fred, what do you expect from the Jackson Hole meeting later this week? Has the market already factored in the possibility of what the Fed might do with the bond buying program as the year wears on?
I think it's pretty well assumed that the Fed will continue to make somewhat less dovish noises than they made, but I don't see any major shift in policy coming. Remember, if you will, that Jerome Powell is up for reappointment in February, so I'm a bit of a cynic and would say that he's likely to hew to the line of strong economic growth and let's let inflation run a little bit. There's still an argument that inflation is transitory. I don't believe it is, but that's okay. That people will have different points of view on that. But I think if you look at what's going to come out of the summit, I don't think it's going to be anything major. Let's remember too that we've seen an increase in interest rates in Europe this morning. But, the fact of the matter is they're a fraction of what they are in the United States. And in Germany, they're still negative. Mm-hmm. So, we can't afford to go too far off the reservation in terms of interest rates because that will be disruptive to rest of world. And I don't think we can ignore that impact. And I think our need to be in compliance with or cooperating with the rest of the world has increased in the last week. Let's face it. As investors, we always look at what are the risks out there, and everybody talks about, there's interest rate, the Fed, and this, are we going to get fiscal stimulus or not? Are we going to get an infrastructure bill or not? But we have introduced this over the last 2 weeks, something we always talk about, but we always talk about it kind of theoretically, which is geopolitical risks. And when you consider our standing in the world right now, I think it's a major risk for the markets. I think it's a major risk for the global economy. I think if you look at what's going on with China in the South China Sea and Taiwan, you look at Russia now more emboldened than ever. I think I think that's a political risk that if there was geopolitical tensions, let me put it that way, that could be the black swan event that we all kind of worry about. We've had 5 years of no meaningful rollover in the stock market. We haven't had a rollover of 5% in 5 years. Okay, eventually that's going to occur. Now, long-term investors will take the view, as we do, that we can't time that. We can't protect ourselves very well against it. We're not going to worry about it. We're not traders. But nonetheless, long-term investment is made up of a lot of short-term decisions and short-term periods. So, we're mindful of the fact that there's some risk in the stock market right now, despite strong earnings, despite strong economic growth.
You brought up the geopolitical risk. I'll just add this, that Armin Laschet, the likely successor to Chairman Angela Merkel, the chancellor, rather, in Germany, said this is the biggest debacle that NATO has seen since its foundation. And we have clearly alienated our allies in Britain, in France. And so, again, the calculation is now we have a president here who looks increasingly incompetent, certainly disengaged from his own advisors. And where does that lead us in terms of national security? It's something we take for granted, quite frankly. I want to get to this. Dallas Federal Reserve Bank President Robert Kaplan joined Maria last week to discuss his views on when the Fed will taper in response to the Delta variant. Listen to this.
But the thing that I'm going to be watching very carefully over the next month before the next meeting is it having a more material impact on slowing demand and slowing GDP growth. And so I'm going to keep an open mind on that. And if it is having a more negative effect, that might cause me to adjust my views somewhat from ones that I've stated.
Nancy, I wanted to bring you in here, your thoughts on that, and also if you just want to weigh in on the conversation with Fred.
Yes, good morning, Dagan. Yeah, well, Fred, you said something super interesting in your notes that I'll get to in 1 second. But I am curious about your view of tapering. Do you think it's a material event for the market? And then secondarily, many of the sectors you like, I like as well. But also they are subject to potential punishment if this human infrastructure bill goes through, with taxes on the global taxes, the GILTI tax that will inordinately affect technology and healthcare. So I'm wondering what your thoughts are on that after you weigh in on the Fed. Thank you.
Well, first, let's recognize the fact that the Fed has been the biggest buyer of Treasury bonds over the last year. They've accounted for something like, I don't know, 3/4 of the buying. They're still buying since 2020, early March of 2020. They bought $1 trillion of mortgage bonds. That continues. So, I mean, there's no question that the amount of buying in this market is controlling the rates. There's no question about that. And I think that will continue one way or the other. They may lessen the rate of it, but I think they're going to continue to control interest rates. If a 10-year at 2% wouldn't bother me at all. I think it should trade higher than that, quite honestly. It wouldn't bother me at 2.5%. But I don't think that's in the cards in the short term, partly because of the what I'll call the global contagion of low rates and stimulus. With respect to your other question about, I don't know if you were talking about sectors specifically, but I think we continue to hew to our line that we like secular growth companies. This is a consumer-driven economy, has been, will be. And I think some of the sectors actually are going to receive potentially some stimulus. If you look at the semiconductor industry, it is of strategic importance to us. We've learned that pharmaceuticals and biotechs are also of strategic importance to us. Pat Gelsinger at Intel is calling for federal stimulus. We've learned that the Skyworks, the Global Foundries and the Taiwan Semis, are fairly important, are critically important. So they're the foundries. That's who actually makes the semiconductors. It's not NVIDIA. It's not Analog Devices. Most of them are produced in these large foundries. And those are of strategic importance to us, and those are not necessarily U.S.-based. Taiwan Semiconductor being the most important, and Taiwan building a plant in Texas currently.
Right.
So I think our view is that stick with the long-term growth aspect, and I think you're right that in this short term there will be some punishment, and industrials and commodities and other materials will be favored.
Fred, thank you for being here this morning. Always, Fred Lane.